Once you start to trade in stocks and options, you're going to want to know everything possible about what affects the price of an option. Because we're using options in our positions for at least the money every month trades, you'd want to know exactly what it is that affects the value of the options that you own or the options that you're selling. And those variables include not only the strike price, the expiration of the option, but also what's called the Greeks. The Greeks include a number of different variables: the delta, the gamma, the theta, the Vega, and rho, which has to do with interest rates. Let's start with delta. Delta is the measure of the change of an option's value with respect to a 1-point move in the underlying, which could either be a stock, a future, a commodity, or an ETF. Now, calls always have a positive delta and puts always have a negative delta. So how do deltas work in relation to our option positions? Well, delta measures how much we can expect an option to increase or decrease in price after a 1-point move in the underlying stock or ETF. So in this case, let's take a look at our position statement here for a second. Our current position statement states that our diamond position has a delta of -16. What that means basically is that if the diamonds were to increase in price by $1 and we are short delta on that position, then we would lose $15 for each $1 price increase in the diamonds. So for every point that the diamonds go up, we will lose $16. Think of delta as an alternative to owning stock. If you are short the stock, what do you want it to do in order to make a profit? You'd want it to go down. So if a price of our diamonds went down by $1, we would gain a $15 profit. So you can look at the delta as a substitute for the way the option will act depending on whether the stock itself, the underlying, goes up or it goes down. And you can tell based on the delta what will happen to your profit position. That's the most practical application of the Greeks, determining what will happen to your position if the underlying stock or ETF goes up by $1 or down by $1. As you can see from this, our overall position and our overall totals for delta for all of our positions is -21. That means we are short 21. You can think of delta as shares of stock. We are short 21 deltas on our entire position. If our position would move down by a point, in this position we would gain $22 if the price of the overall market were to decline. On our individual positions, however, the diamonds would increase by $15.63 for each 1-point drop in the diamonds. Our EEM position would actually gain 58 cents by an increase in the price of the EEM by $1. The IWM would increase by $23 if the price were to go up by $1. And the SPY position would increase by $33 if we were to drop a point in the SPY. The overall aggregate total of these positions is called the net delta. We are net delta and we are short delta by 24. To make this as easy as possible, think of this as an indicator to tell you what would happen if the price of your underlying position were to increase or decrease by $1. In this case, since we are net short 24 deltas, if our position would go down by $1, we would gain a profit of $23. If it goes up by $1, we would lose $24. So it's only an indicator. When it becomes really significant is when these numbers become so large that it's quite obvious that an adjustment is going to be necessary so that we don't lose a great deal of money. When the delta becomes negative 300, for example, and the market is railing up as it is today, it's up 113 points as represented by the Dow Jones Industrial Average, then we would be losing close to $300. That's a significant position that needs adjustment, otherwise we could be in a position to lose a lot of money. As it is, we're only 19 shares short, so it's a short delta, so it's very, very close to neutral. And that's not a bad position to be in, given our other Greeks.